Bitcoin's up nearly 300% since January, and people are still calling it flat. Meanwhile, gold's up 70%, and Wall Street's popping champagne. But the real move? It's happening behind the scenes. Today, we're breaking down 3 major shifts. Why Bitcoin's breakout is misunderstood, how central banks are silently rotating in, and why US policy may be setting up BTC as a reserve asset. Stay to the end, because next time they print trillions, Bitcoin may already be on the books. And macro investor Anthony Pompliano is already seeing the cracks form. He lays out how Bitcoin has outpaced gold, what's really driving adoption, and why younger central bankers could push BTC into official reserves faster than anyone expects.
Now, why is gold 70% up and you say that Bitcoin is flat? Well, it's all about relative performance to expectations, not necessarily to other assets, because Bitcoin is still destroying all of these other assets. Bitcoin was $70,000 in November of 2024. It's now $115,000. So it's appreciated quite a bit. Now, on top of that, Bitcoin was $40,000 in January of 2024. So Bitcoin is up almost 300% in the same period that gold is up 70%. So yes, gold is up a lot compared to its historical kind of volatility. Bitcoin is up a lot compared to gold, but people expect Bitcoin to go up hundreds of percent every single year. And so when it doesn't do that, then people start to think, oh, why is Bitcoin not up more? Oh, I thought that Bitcoin should be up more. Gold's up 70. Why isn't Bitcoin up 1,000? Right? That's kind of what we're starting to see. So it's always very important to separate yourself from the feelings over the facts. And the facts are that Bitcoin's up a lot in the same period that gold's up a lot. Why? Because not only central banks, but companies, investment firms, individuals, organizations, nonprofits, everyone who can allocate capital is realizing that holding dollars and bonds is a losing trade, and therefore they want to hold sound money principles. And you're watching that play out with the adoption of gold and the adoption of Bitcoin. Both are going much higher, and I don't think it's going to stop anytime soon, because we're about to get rate cuts, more money printing, and people are going to realize that the problem that they're running from is only about to get worse, and therefore they need to put bigger and bigger allocations into Bitcoin and gold.
He's got a point. Everyone's calling Bitcoin flat, but they're looking at it through the wrong lens. BTC didn't underperform. It broke out, just not in the dopamine-fueled way retail expects. What most people miss is Bitcoin has already outpaced everything, including gold. From 40K in January to 115K now. That's nearly 3x in 9 months. Gold up 70% in that same window. That's strong, but let's be real. Bitcoin is still crushing traditional assets. So why do people think it's lagging? Because expectations are broken. We've been conditioned to expect parabolic moves. And when that doesn't happen, the narrative turns negative, even when the data is screaming the opposite. Here's where this gets interesting. The real buyers aren't watching the charts. They're watching central banks. Pomp nails it. Look past the price. Watch the flows. Central banks, corporations, non-profits, they're reallocating away from dollars and debt. This isn't hype, it's rotation. Quiet but aggressive. They're moving into sound money assets, and both gold and Bitcoin are riding that wave. This is the start of a new playbook, not a replay of 2021. If this trend holds, Bitcoin doesn't just beat gold, it redefines the risk-off trade entirely.
So that's where Bitcoin, I think, has really been pretty interesting, is this idea of how do we go and use the tools that are available to go and buy more Bitcoins. People mining it, buying it, holding it, earning it, all these things. And so I think central banks eventually, they're going to do the exact same thing. It's just that right now, central banks, it is an accepted thing for them to buy gold. What do you think they're going to do next? They're going to extend out. We want sound money principles. So outside the system, no one can print more of it. Okay. Well, gold's a great thing for that. Bitcoin's a great thing for that too. And as young people ascend to the positions of power and influence inside of these central banks, they're going to start buying Bitcoin. It's just a matter of when are they going to do it? Are they going to talk about it publicly when they start to do it? What are the implications of it? I mean, there's a whole conversation we could have based off of that, but it's going to happen.
That's not a maybe. That's a matter of time. Central banks are still playing it safe with gold, but Pomp's right. They're going to start buying Bitcoin. The case for Bitcoin on government balance sheets is stronger than ever, and no one's talking about it. Why? Because the logic is bulletproof, can't be printed, immune to sanctions, verifiable in real time, has deep global liquidity. And as younger generations move into policy-making roles, we're not going back to the gold standard. We're skipping straight to the protocol layer. This shift won't be announced. It'll just happen. We've already seen it at the edges. El Salvador, Dubai, even Swiss pension funds. The pattern is always the same. It starts small and then suddenly it's everywhere. This isn't about ideology, it's about efficiency. The next generation of central bankers will treat Bitcoin like their predecessors treated gold.
If the Federal Reserve tomorrow said, hey, we're going to print, $2 trillion and we're going to go and we're going to try to buy as much Bitcoin as we can. And because Bitcoin's entire market cap is a couple trillion, right? It's going to send the shit, flying. Sure. Then other central, oh my, that's not how central banks really work, right? They're pretty prudent, not always smart, but they're pretty prudent in terms of, trying to steer like a cruise ship more than a speedboat. And so I just think that it's time. Like that is the biggest thing, is we just need time to pass. There's some competitive dynamics to it, but I think more importantly is simply just saying, look, let time pass, let young people get into these positions. Let's, kind of death by thousand cuts, right? The Treasury is now more sympathetic to Bitcoin than it was 4 years ago. Okay. So is the Fed, it seems like, the SEC, the president, right? Like just think of the change that's happened in the last 4 or 5 years. We went from anti to pro. We didn't really do that much. Yeah, we set up a strategic Bitcoin reserve kind of, right? Like we didn't buy more, at least not publicly. We're not mining any as a country. We just had a sentiment shift. It's kind of the American strategy, right? Like push the productivity and the opportunity to the private sector. Let them go do this stuff, right? But I do think that you'll see change happen at some point. Just gonna take some time.
Now this is where it gets real. The US hasn't officially bought Bitcoin, but the private sector is doing it for them. This is the playbook. Let private firms front-run the nation-state trade. Coinbase, BlackRock, Fidelity, MicroStrategy, they're absorbing the risk, building the rails. The US is just quietly positioning itself to benefit without lifting a finger. And we're seeing the sentiment shift in real time. The Fed isn't openly hostile anymore. The SEC approved multiple BTC ETFs. The Treasury is exploring Bitcoin as a reserve proxy. As Pomp says, it's death by a 1,000 cuts. But from where we're sitting, it's a strategy, and it's working. When the next $2 trillion in liquidity hits, BTC will already be on the books. Pomp made it clear, capital is rotating into sound money. But what if the rotation itself is part of a much larger macro shift? Tom Lee from Fundstrat thinks we're not just in a bull run, we're at the start of a new financial cycle. He says the real catalyst isn't just Bitcoin or inflation, it's demographics, AI, and the Federal Reserve. And what he lays out next could explain where this market's going through 2035.
I think we are in a new bull market because we just had another essentially wipeout that happened February to April this year. I do think that the bigger story arc is that there is a big surge in US prime age workforce. That's the millennials and Gen Z. Plus, they're inheriting a lot of wealth over the next 20 years, which is going to be transformed into more equity exposure, less credit. And the third is that the US is at the center of a lot of the major structural changes taking place, AI and now blockchain. But those are going to really boost financial sector, which could re-rate to like 40% of the S&P, and then of course healthcare could benefit. So I think there's a lot to be excited about, and 2035 sounds about right. That would be a 10-year bull run from here.
Tom Lee's bullish, and he's not thinking in months, he's thinking in decades. According to him, we're not just in a recovery, we're in the early innings of a 10-year bull run that could stretch all the way to 2035. This isn't just another cycle, this could be the super cycle. Why? 3 key drivers: a demographic surge in millennial and Gen Z workforce participation, a massive wealth transfer already underway, the US leading in AI and blockchain infrastructure. That's not hopium, that's macro math. 78 million Americans between the ages of 25 and 44 are now entering their prime earning years. That's more than the entire population of Germany entering the market with cash and risk appetite. And that generational wealth transfer, according to Cerulli Associates, $84 trillion is expected to change hands by 2045, and younger investors aren't parking it in bonds or savings accounts. They're buying equities, Bitcoin, crypto, and growth assets. If Tom Lee's right, the structural tailwinds are in place, and this isn't just a bounce, it's a foundation.
Fed independence is really important because the Fed is the single most powerful entity in the world, right? Because what the Fed says triggers an instant response across all markets and CEOs and policymakers everywhere and even government. So that being independent is critical. I think that we're going to ultimately find that the administration does accede to what markets rationalization is, and I think the markets don't want to see a non-independent Fed. I'm going to lean towards the idea that Fed Chair Powell serves his term. But even if it's just noise now, it is just someone comes across as more not happy with policy, but they're not going to interfere.
But here's the catch. It all hinges on the Fed, and Lee makes it clear. The Fed is the single most powerful entity in global markets. One statement can trigger reactions from Wall Street to Washington. Markets don't follow the Fed, they react to it instantly. That's why independence matters. And even though the current noise around policy frustration is loud, Lee believes the White House won't risk politicizing the Fed. Why? Because the market won't accept it. A Fed that isn't trusted by the market, that's when confidence collapses. He's drawing a line between political dissatisfaction and actual interference. If that line holds, this market still has room to run because investors believe the Fed will act rationally. But if that changes, all bets are off.
The Fed could end liquidity and that would create a pullback. I mean, even a bear market. I mean, like if we saw it in 2022, the Fed had to basically put a heart attack on the economy and the stock market fell. So if the Fed decided that the economy was overheated, there is no bull market beyond that point.
And here's the risk no one's pricing in: a hard liquidity stop. Lee calls it like it is. If the Fed ends liquidity again, like in 2022, the market could face another heart attack moment. The number one thing that kills bull markets? Liquidity shocks. In 2022, QT slammed the brakes on everything: equities, crypto, and real estate. A repeat would wipe out bullish sentiment overnight. The good news? We'd likely see the warning signs before that happens, in bond yields, risk premiums, and Fed minutes. This market lives and dies on liquidity. And right now, the Fed is watching, not choking, the economy. Tom Lee painted a long-term bull market fueled by demographics and liquidity. But what if we're not just witnessing a market cycle? What if we're entering a new digital financial regime? Jordi Visser, CIO of Vice Multi-Strategy Advisors, says the future of Bitcoin isn't just about price or policy, it's about belief. And if he's right, we're about to see a wave of capital that doesn't just invest in crypto, it redefines the way portfolios are built. This isn't just a bull run, it's a portfolio reset.
We've all heard about how liquidity is good for Bitcoin. Well, historically, when liquidity goes higher, guess what else goes higher? Eventually, PMIs go higher. It's the business cycle. So there's a bunch of things that happen. One of them is the fact that as we start seeing PMIs go higher, it makes the strength of the liquidity situation good. If you add in the fact this time that we're going to be cutting rates, the whole thesis behind everything going on, if you take what has happened this year, the government is getting policies through for stable coins. We've had successful IPOs. When you and I this year at the beginning, if we would have taken a survey of traditional finance people, what do you think about stable coins? I can't imagine that 5 out of 100 people would have had an opinion on them as anything. Now they're an investable asset. They're investable through Circle and they're investable through Ethereum. And all of a sudden, everyone's doing their fundamental work on Ethereum going, wow, there's things on here that remind me of the traditional finance world. So that's good for Bitcoin because the network effects are growing. So once you get through the network effects, which is the innovation side, which is getting more and more people to use it, you're getting into the AI side, the convergence between AI and stablecoin. So the the transactions explode. All of the AI stuff, which is directly related to PMIs, which historically is directly related to any kind of growth that's happening in the economy, is good for Bitcoin because people are willing to invest more, because traditionally you start getting a tide that lifts all boats. And that's the line that I want to say for diffusion indexes is a tide that lifts all boats means people have the ability of investing in a broader universe of things. And as I've said before, the biggest problem that's been for Bitcoin has been you didn't need to invest in it. It's a big behemoth asset now. It's one of the largest assets in the world. I don't need to buy it because it's just a beta of NASDAQ. It's just the Mag 7. Well, if the Mag 7 aren't going up anymore, which I don't believe they will in the rate that they had, and Bitcoin starts to outperform, which will come from the PMI because small caps typically do better. It's a tide that lifts all boats. And when you start lifting all boats, you don't need to have a concentrated portfolio of the 7 that are working. You can actually extend out. So I think investors, traditional finance investors, 401k, all the things that we've opened up are going to start looking for something that acts like beta and growth in a portfolio that's a big asset. And I think that's going to bring more and more money to it.
Bitcoin thrives on liquidity, and liquidity is rising. Visa draws a powerful connection. As global liquidity expands, so do PMIs, purchasing managers indexes, a classic leading indicator for economic growth. That's bullish, but this time something different is happening. Liquidity isn't just helping tech stocks, it's reshaping the crypto foundation. Stablecoins are no longer fringe. Policies are being pushed through. IPOs are hitting. Traditional finance, once silent on crypto, is now running due diligence on Ethereum's fundamentals. That's how network effects grow. And when they overlap with AI, things start compounding. As AI agents begin transacting and allocating, the tide lifts all boats. Small caps, crypto, even Bitcoin. PMI surges equals more risk-taking, and risk-taking leads to Bitcoin outperforming the Mag 7. Visa believes we're nearing that pivot, where Bitcoin stops tracking just the NASDAQ and starts leading it. Why? Because when investors start looking beyond the 7 megastocks, they'll need new, liquid, high beta assets.
Bitcoin is the original cash creation. It was the invention for digital money. So if you start with that and you realize it's about 60% of the crypto market cap, so you're right now crypto market cap somewhere just south of 4 trillion, the digital economy is going to grow exponentially. Now, the digital economy has been growing exponentially for a while. And so the thing that I believe is that Bitcoin shouldn't be viewed relative to gold. It should be viewed relative to the Mag 7. The Mag 7 right now is up near 13 to 15 trillion. It's a big number. The reason it's gotten so big is because people have owned it. It's a massive part of people's portfolios. If everyone goes into there's almost nobody on the planet that doesn't own NVIDIA at this point. It's 5% of the S&P 500. It's a major part of all benchmarks. So when you have stocks that are that big and part of the portfolio, we all make decisions in our portfolios based on returns. And what questions the returns is when we're not beating bonds or we're not beating some benchmark. If the Mag 7 stop producing the types of returns they have.
Bitcoin currently makes up 60% of crypto's 4 trillion market cap, but Visa says that's not how we should be framing it anymore. Bitcoin isn't just a digital gold play, it's a Mag 7 replacement. He's comparing BTC not to gold, but to Nvidia and Apple. The Mag 7 sit near a 15 trillion valuation, but their growth is slowing. Meanwhile, Bitcoin has near perfect liquidity, global ownership, and constant price discovery. Visa's point? When portfolio managers stop outperforming with mega cap tech, they'll need something that offers asymmetric upside, and Bitcoin becomes the logical choice.
You cannot invest in ideas the way that you have in the past. Ideas are stocks. Bitcoin is a belief. Beliefs last longer than ideas. There's no companies in the S&P 500 from, 100 BC. Gold's been around since then. Bitcoin will be around for a long, long time. It's a belief at this point, and people can fight it, but it's going to be around. I think you want to start shorting ideas and you want to be long beliefs as people move more money into the digital economy, which is just starting now because of the government regulations. Stablecoins growth will represent it, but the other thing that's going to happen, AI agents agents are going to make intelligent decisions. And those intelligent decisions just start with what has the best Sharpe ratio, what has the most liquidity. Well, if you just do it that way, Bitcoin wins over every asset in the world, 24 hours a day, liquidity all day long. I think that's what's coming.
You don't invest in ideas, you invest in beliefs. That's Visser's framing, and it's powerful. Bitcoin has crossed the line from a volatile asset to a cultural and financial belief system. Ideas fade when performance dips, but beliefs stick. The S&P 500 has no stocks from 100 BC, but gold made it. Bitcoin could too. He sees Bitcoin outlasting tech fads because now it's not just driven by humans. AI agents making intelligent investment decisions are going to favor liquidity and the Sharpe ratio. And when those agents scan for efficiency, Bitcoin wins every time. Bitcoin's edge? 24/7 liquidity and unbeatable risk-adjusted returns. With stablecoin rails expanding, AI integrating, and regulation opening doors, Bitcoin is becoming programmable belief. So far, we've heard about belief systems, demographics, liquidity waves, and capital rotation. But what about the technicals? Are the charts actually confirming the bullish macro narratives? Gareth Soloway, Chief Market Strategist at Verified Investing, is one of the most respected chart analysts in the space, and his recent breakdown of Bitcoin, Ethereum, and Solana just flipped a key signal. Watch till the end, and you'll understand the technical setups behind BTC's possible run to 120k and what could instantly invalidate it. We're not guessing anymore. Bitcoin's structure is clear, and it's bullish.
And then notice how price kept bouncing, but then finally broke to the downside. And then look at how price retraced, but this now becomes resistance. Remember, one of the key caveats or factors in technical analysis is that support becomes resistance and resistance becomes support. So when you break a support level and you confirm below it, it now solidifies as resistance. And that's exactly what has happened here on Bitcoin. When you broke down, this now became resistance. And sure enough, it rejected price and price continued to fall. The other thing to take note of here is you have basically what we would refer to as a classic double top. Double top is a high pivot, a pullback, a revisit of that high pivot. Usually it makes a slightly higher high because you got to get the bulls as bullish as possible, and that's by making a new all-time high. It does that in this scenario. And then look at the candle that followed it. Anytime you get a candle like this where you have a green candle that's big, but then the red, the next one is engulfing, it essentially negates the entire green, that is a reversal bearish signal. All right, again, notice this again, there's some criteria. Number one, it was at double top. Number two, it made a new high, a new all-time high. Number three, big green candle followed by a massive red candle that engulfed the green candle prior. That again is a bearish indicator on a chart. So if you see that again, it could be a stock chart, it could be a commodity chart, but in this case, it's a crypto chart. It is a very key signal to watch.
Soloway opens with one of the most textbook reversals in crypto, the inverse head and shoulders on Bitcoin's daily chart. Over the last several weeks, Bitcoin's price rejected repeatedly off a major resistance, but recently closed decisively above it. That's not just a breakout, it's confirmation. The neckline has been cleared. He compares the setup to a hill. When the price breaks on one side, it flows fast to the next level. On the shorter time frame, the hourly chart, you see a clean left shoulder, head, and right shoulder. If the pattern holds, Gareth projects a breakout target of 119 to 120,000, aligning almost perfectly with a major prior pivot. But, and this matters, this setup isn't bulletproof.
All right, and really understand what it means. All right, so we broke down. Notice where the first bounce came in, guys. So again, if we look at this very, just simply, we look at this was your first bounce level. See this low pivot? So this pullback low, which had hit this support area and bounced. Now, when we dumped and broke below, it tried to break it, and then finally, boom, it went up. And then look at what happened here. If we extend this out, look at how amazing this is, folks. And again, I'm going to change the color of this because it's so important to see. You have support, hits, tries to break, bounces, then finally comes down and breaks. And what do we know? What happens to support when it's broken? We learned it right over here when we retraced. This became resistance. Same principle applies. It breaks, retraces. This is now resistance. It fell again. And look at where we're hammering on it again, right to that level.
A valid breakout needs to hold its structure. Gareth is clear. A daily close below $113,300 invalidates the pattern. That wouldn't crash Bitcoin, but it would remove the clarity of the current setup and kill the 120,000 projection. 113K is now a make or break level, bullish or busted. So long as BTC stays above the neckline, bulls are in control. But technical patterns don't care about height, they care about levels.
So now we've just taken what looked as just a chaotic chart. It is now making more sense. It shows us exactly what we want to see in terms of what are some key levels to watch. So what would be the first key level to watch on Bitcoin? And the answer is this level here at around 112,500. If price can get above this and hold, essentially now you've broken above that level. Right now it's into that resistance. We got to favor a rejection. But if it can push above 112,500, now it's game on. Now we could be headed up. Where could we head up? Well, potentially you could extend this out, right? We could extend this out here, and then we extend this out, and you could see Bitcoin rally if it breaks here all the way up into that level. Now, why would this level be major resistance? Number one, it's retracing to your all-time highs, so you have a double, that would be a triple top, and also it's converging with this upsloping trend line. Two trend lines, when they converge, become even bigger resistance.
This is where crypto gets disciplined. Now let's look at Ethereum. Gareth describes ETH as in a yellow light zone. Not bullish, not bearish, but on watch. ETH recently broke below a key trend line, but hasn't confirmed the breakdown with a daily close under $4,240. No confirmation, no collapse. ETH still has a shot at 5K. If ETH closes above $4,500, Gareth expects a move back to $5,000. If it closes below $4,240, we could see a drop to the 3,875 range. Right now, Ethereum is caught in neutral territory, and traders should be waiting, not rushing. Soloway's advice here is simple. Yellow means watch, not act.
Even bigger resistance. And so the idea is if that did happen, you'd expect a rejection. Now listen, it could be rejected and then eventually it could break to the upside and break out. But in the very near term, if it hits this, you would expect a rejection to the downside. Now, let's take it from another step. What happens if Bitcoin gets rejected here? Well, you're in a short-term downtrend. You've broken your uptrend. This was your uptrend. Trend line. Remember, trend line has trend in it. So trend, it was following this trend. It broke. And so if it can't get above 112,500, guess what? It's going to come down, make lower lows. Your next big stopping point on this merry way is going to be about $100,000. All right. So again, now, right now, everyone always asks me, well, what is your bias, right? What is your bias on price? I always defer to the charts. The charts know so much more than me. I can speculate, but really the charts will give me more information. And so to do that, we say, okay, well, let's flip back to the charts here and take a look. We say, okay, well, it hasn't broken through this level, so we can't assume it will. As long as it doesn't break through there, it's the downside or negative bias on Bitcoin with a downside target of $100,000. Now, again, if we break up here, then your bias has to flip from negative to positive, and you start expecting a move back up to about $123,000. Okay, so this is really a very near-term pivotal level here that we should watch, but we haven't broken through it. Therefore, we have to just go with what the chart is, which is saying it hasn't broken. We can't assume it's going to break, so therefore we favor the downside near term. All right.
Finally, he gives a quick read on Solana. Solana has just breached a resistance line and closed above it, suggesting a possible upside move toward the $244 to $245 level. While ETH is hesitating, Solana Solana might be leading. The price structure on SOL is clean, and this breakout could lead to further rotation as investors diversify within the L1 ecosystem. Levels matter. Liquidity confirms. Gareth's read is more than just drawing lines. He's tracking momentum, confirmation, and the behavior of smart money. The bullish macro narratives from Pomp, Tom Lee, and Jordi Visser, they're lining up with these technical breakouts. BTC breakout confirmed. ETH in decision zone. Sol pressing higher. But this also shows us the psychological precision of the market. Break above a level, buyers flood in. Break below it, liquidity vanishes. And that's why we respect technicals, because in a world of noise, charts tell the truth. If this helped shift your perspective, do one thing before the next candle prints. Don't forget to subscribe. We don't chase pumps. We track the cycle, decode the charts, and connect the dots. Every episode, every week. Let's ride this cycle the smart way.